In 2007, Warren Buffett made $1 million wager that exposed the funniest, most humiliating secret in modern global finance. He bet that a completely unmanaged index fund that automatically buys the top 500 companies and does absolutely nothing for an entire decade would thoroughly humiliate an elite portfolio of hand-picked hedge funds managed by the sharpest minds on Wall Street. By 2017, Buffett hadn't just won the bet by a landslide. He had completely dismantled the collective ego of the financial elite by proving that a brain-dead, automated computer strategy outperformed highly incentivized professionals. This structural anomaly brings us directly to the market efficiency paradox, a systemic reality where the harder Wall Street fights to extract profits, the more profitable it becomes for the rest of us to simply sit back and do nothing. We are going to strip away the complex corporate jargon and examine how the entire global financial machine is actually rigged to turn hyperactive traders into free, involuntary labor for your retirement account. To understand why doing absolutely nothing beats trying to do everything, we have to look down into the actual cold, mechanical engine of an asset exchange. Every single stock price you see flashing on a smartphone screen is an illusion created by a continuous, microscopic war inside a digital structure called the order book. Think of the order book as a highly aggressive, decentralized ledger filled with buy-side jars and sell-side jars at varying price levels. On one side, you have limit orders from people waiting to buy an asset at a specific cheap price. On the other, you have sellers demanding a specific premium. When an average retail investor places a standard market order, they are essentially saying they will accept whatever random price is currently available right now. If the order book lacks depth, that market order tears through the jars like a bowling ball through pins, causing massive price distortion known as slippage. This is where market makers step in. They are automated, algorithmic entities that constantly populate both sides of the ledger, narrowing the spread to a fraction of a cent. They do not do this out of the goodness of their hearts. They are financial vultures feeding on the microscopic delta between the buy and sell price. But their ruthless competition creates an accidental public utility. They provide deep liquidity, ensuring that when you hit buy, you get a fair price instantly without accidentally moving the market against yourself. The earliest and coldest form of algorithmic execution is pure arbitrage, which is nothing more than exploiting the laws of spatial physics across disconnected digital networks. In the chaotic frontier of any new asset market, a specific asset might trade at $1,800 on one poorly optimized exchange and $2,000 on another across town. A simple automated script can buy the underpriced asset in one location and sell it instantly in the other, extracting a completely risk-free profit. It gets infinitely more sophisticated when computers scan multi-currency loops, executing triangular trades from US dollars to Bitcoin, then to Ethereum, and back to fiat currency within milliseconds. If the multiplied exchange rates do not equal exactly 1, the system detects a geometric distortion. We can view this entire market dynamic as a high-dimensional mathematical model where perfect equilibrium forms a completely flat, no-profit surface. Every single time a price drifts off this line due to localized panic or sudden demand, a profitable valley opens up. Algorithmic arbitrageurs flood into that valley, extracting the delta and pushing the market point right back onto the equilibrium plane. They are the unpaid mechanics of global capitalism, spending billions on faster servers just to keep the world's prices perfectly synced for you. But pure mathematical arbitrage is a brutal arms race that decays rapidly as more players arrive with faster fiber optic cables. Once the instant anomalies are crushed to zero, traders are forced to pivot to future arbitrage, which is just a polite way of saying they are trying to predict the future. This is the domain of Benjamin Graham and his classic concept of Mr. Market. Graham described the stock market not as an efficient calculation engine, but as a deeply erratic, highly emotional business partner who knocks on your door every single morning offering to buy or sell shares at wild, unpredictable prices. Some days Mr. Market is intensely euphoric, pricing companies as if they will conquer the universe. Other days he is profoundly depressed, dumping world-class assets for pennies on the dollar because of temporary bad news. Long-term fundamental investors exploit this psychological instability. When Warren Buffett put over $1 billion into a mature, boring soda company in the late 1980s, Wall Street analysts scoffed at the idea. But Buffett looked past the daily noise of the trading floor and analyzed the structural expansion of global consumer markets. He noticed that while the average American consumed hundreds of servings of soda a year, emerging markets in Asia and developing nations were consuming almost zero. It wasn't a gamble. It was a long-term statistical bet that global infrastructure expansion would inevitably drag the rest of the world into an American lifestyle. Buffett bought the asset while Mr. Market was bored, sat completely still for decades, and watched his position balloon into a multi-billion-dollar empire. While long-term investing sounds peaceful, it cannot exist without the violent, high-stakes ecosystem of short-term macro traders who react to information second by second. When geopolitical tension flares, when oil cartels attempt to manipulate production cuts, or when central banks unexpectedly alter interest rates, prices instantly disconnect from their historical baselines. Elite macro traders stand directly in the line of fire, making massive directional bets on how human psychology and global logistics will unfold over the next 48 hours. The market does not care about your academic credentials or your theories. It only rewards immediate, raw accuracy. If a prediction market misprices a catastrophic event or a political selection, independent researchers can exploit that information gap to extract massive payouts. They act as information gatherers, aggressively scanning the world for data gaps, buying up undervalued risk, and forcing market prices to reflect the true state of global affairs. They are the sensory nervous system of the financial beast, constantly feeling for pain and adjusting the system's internal values in real time. In the late 1980s, this manual process of interpreting news was permanently automated by quantitative pioneers who realized that entire groups of stocks move together in complex, hidden patterns. This birthed statistical arbitrage, starting with simple pairs trading. If you look at two nearly identical corporations serving the exact same market with similar products, their prices naturally walk hand in hand because they face identical macroeconomic conditions. Instead of a rigid mathematical line, their relationship forms a fuzzy corridor of historic correlation. If an internal corporate blunder or localized panic causes one stock to plunge while the other remains stable, the statistical arbitrage algorithm instantly triggers a trade. It buys the artificially depressed asset and shorts the inflated one, betting heavily that their historic relationship will inevitably normalize. Quantitative firms took this foundational concept and scaled it across thousands of global equities simultaneously, mapping complex relationships that resemble high-dimensional tubes moving through price space. When a massive tech company announces stellar earnings, the financial news ripples outward in a predictable cascade, affecting direct competitors, then immediate component suppliers, then logistics providers, and finally raw commodity markets. Modern computerized models ingest everything from live satellite imagery counting cargo ships to real-time weather patterns and alternative credit card data. Machine learning systems map these interlocking real-world connections as hyper-complex, curved mathematical surfaces completely invisible to the human eye, executing millions of precise microtrades a day to capture a fraction of a penny on each movement. The absolute zenith of this mathematical approach was achieved by legendary quantitative funds that deliberately refused to hire anyone from the traditional financial sector. Their founders famously stated that you can easily teach a physicist finance, but you can never teach a traditional Wall Street trader advanced physics. Their teams treated the global financial market purely as a vast, non-linear system of mathematical time series. They didn't read analyst reports or visit corporate headquarters. They built predictive algorithms that detected microscopic geometric distortions in price data. These models calculated the precise probability of asset movements based on variables so subtle that even the scientists couldn't explain the underlying economic cause. If the data indicated a highly repeatable anomaly occurred every single Wednesday at 2 in the afternoon under specific atmospheric conditions, the machine traded it ruthlessly. They became the ultimate automated execution engines, vacuuming up billions in pure profit by maintaining an absolute statistical edge over every other participant in the market. This hyper-expensive, high-velocity arms race brings us right back to the core mystery of the market efficiency paradox. If these brilliant quantitative geniuses, armed with supercomputers and alternative data streams, are perfectly optimizing the market every single second, how can a brain-dead retail investor beat them by doing absolutely nothing? The answer lies in a beautiful macroeconomic insight pioneered by William Sharpe in the 1960s. Sharpe realized that if you look at every single investor, hedge fund, and algorithm collectively, they represent one singular entity voting with their capital on what the entire world is worth. If you add up every single dollar deployed across the financial system at any given moment, you get a single consolidated portfolio called the market portfolio. Because active traders are constantly buying and selling pieces of this portfolio from each other, their collective returns must exactly equal the average return of the market before expenses. But active trading is an incredibly expensive endeavor. It requires billions in management fees, specialized data feeds, transaction costs, and massive server infrastructure. When this mathematical reality was turned into the very first retail index fund in 1976, it gave regular people a structural superpower. By buying an index fund, you are choosing to automatically own a small, perfectly proportional slice of the entire market portfolio. You do not pay elite hedge fund managers 2% of your wealth every year to chase fleeting returns. You do not pay transaction fees or capital gains taxes on continuous trading. Instead, you sit entirely still and let the index fund automatically adjust itself. As new information is injected into the system by high-frequency algorithms and quantitative funds, the values of individual companies rise and fall, causing your index fund to reallocate its weightings perfectly and seamlessly for free. You have effectively conscripted every brilliant mathematician, every quantitative supercomputer, and every elite Wall Street analyst to work directly for your portfolio 24 hours a day, entirely for free. They spend billions of dollars fighting each other to find the exact fair price of a stock, and the moment they find it, your index fund automatically reaps the benefit of that perfect efficiency without spending a single dime on the research. The active investment industry is running an exhausting, high-risk marathon where one single miscalculation results in total financial ruin and bankruptcy. The index fund doesn't run the race, it simply owns the track and collects a royalty on every single runner who passes by. The ultimate secret to winning the most hyper-competitive game on the planet is the conscious decision to refuse to play it. We break down exactly how power, money, and businesses really work. If you want to understand the mechanical reality behind these financial empires and protect your capital from the hype machine, subscribe to Wealth Decoded. Drop a comment below and let me know what systemic industry we should decode next, and I will see you in the next analysis.